Assalamualaikum warahmatullahi wabarakatuh. Hello, I am Febrya Eka Dewanty from International Accounting, Andalas University. In this opportunity, I would like to present my final paper on seminar accounting about comparative analysis between leasing and bank credit on fulfillment fixed asset. And this paper consists of three chapters. The first one, introduction. The second one is discussion. And the third one is conclusion. Here, I would like to explain about the first chapter is introduction. Introduction consists of three sections. Okay, the first section is background. There are three background as the reason that I choose this topic. The first is business competition is one of the major risks for every company. With the increasingly competition that occur between the companies are required to prioritize customer satisfaction, but still don't forget the company's goal to get the maximum possible profit or to maintain the profit earning. The companies should be ready to compete in the current era is to have courage to take the decision to increase the production or to create a new innovation in the production. To increase the production, the company should increase fixed asset that help smooth the company's operation. Here, bring into the second background is the need a large capital to buying fixed asset in cash. However, if the company don't have enough cash, there are another way to fulfill the fixed asset. There are the leasing and bank credit. But it can be the last background here because there are pro and contra in choosing leasing and bank credit, such as bank credit will affect the liquidity and solvency of the company by increasing the debt to the bank. So you should choose leasing because the financing companies are useful for helping the companies with limited capital and maintaining the company's solvability. Or we should know the purpose of the credit from the companies is to increase the volume of business and business result that will ensure the survival of the companies. With these aims, it can be expected that there will be an increase in the company's product activities, so we should choose the bank credit. Uh, so there are some previous research that conducted about this topic, and I will try to explain more about the topic in the discussion chapter. Based on the background, this paper aims to answer this problem formulation. That is, which one is more profitable between leasing and bank credit on fulfillment fixed asset. So, the objective of this paper are to know and analyze which one is more profitable between leasing and bank credit on fulfillment fixed asset, and also to give recommendation for the company who confuse to choose leasing or bank credit on fulfillment fixed asset. The second chapter is the discussion. There are some sections in this chapter that I will explain more about the comparison of leasing and bank credit, such as definition of lease, types of lease, definition of credit bank, and so on. The first section in this chapter is the definition of lease. There are so many definitions about lease from many such, but in this paper, I only choose 5 such definition of lease. The first one is from joint decree from 3 ministers, Minister of Finance, Minister of Industry, and Minister of Trading. This joint decree about the permission leasing business. In this such, state that leasing is defined as any company financing activity in the form of providing capital goods to be used by a company for a certain period of time based on the periodic payment accompanied by the right to choose from the company to buy the capital goods concerned to extend the term based on the mutually agreed residual value. And the second source is from Kemenq RI or Keputusan Menteri Keuangan Republik Indonesia about leasing activities. Article 1 letter A states that leasing is defined as a financing activity in the form of provision of capital goods either on the lease basis with option right or financial lease, or a lease without option or operating lease to be used by the lease for a period based on the periodic payment. The third source is from Marpaung in 2004. According to Marpaung, a leasing company is a company that provides service in the form of leasing capital goods or production tools in the medium or long term where the lessee has to pay a periodic amount of money consisting to the depreciation value of an object. Lease plus interest, other costs, and the profit expected by the leaser. The fourth source comes from IAI or Ikatan Akuntan Indonesia in 2012. They state that lease is a contractual agreement transfer the right to use the asset within the specified time period. And last source is from Zaridis in 2017, state that leasing is a method, but above all, a financing technique that allows business either to obtain use of capital goods without cash flow disbursement or to utilize any unused funds already invested in capital goods. From the five sources of the definition of lease, it can be concluded that the leasing is an agreement between the lessor and the lessee, whereby the lessor provides goods with the lessee's right to use in exchange for lease payment for a specific period. Next is the parties of leasing transaction. There are three parties of leasing transaction. The first one is lessor, the second one is lessee, and the last one is supplier. The lessor is a leasing company that has ownership right over the capital goods. Leasing companies provide funds to those in need. In the business of procuring capital goods, usually the leasing company deals directly with the seller or supplier and has paid off the capital goods. The lessor aims to recover costs that have been incurred to finance the provision of capital goods by obtaining a profit and providing maintenance and operation of capital goods service. Lessee is a company or user of capital goods who have option right at the end of the leasing contract. The lessee who required capital goods is directly related to the lessor, who has financed the capital goods and has the status of the owner of the capital goods. The capital goods that are financed by the lessor are then transferred to and used by the lessee in carrying out their business. At the end of the leasing contract, the lessee returns the capital goods to the lessor unless there is an option to buy capital goods at the price based on the salvage value. And the last one is the supplier, is the seller of capital goods, which is the object of leasing. The price of the capital goods is paid in cash by the lessor to the supplier for the benefit of the lessee. The supplier can have the status of a capital goods producer company or an ordinary seller. There is also a type of leasing that doesn't involve the supplier, but rather than a bilateral relationship between the lessor and lessee, for example, in the form of a sale and leaseback. Okay, next section is the types of lease. There are two types of lease. The first one is the financial lease or the capital lease, is the lease that transfers substantially all the risks and rewards incidental to ownership of an asset. And the another types is the operating lease. The operating lease is doesn't transfer sufficiently all the risks and rewards incidental to ownership. If the lease contract indicates a transfer of asset from the lessor to the lessee, is considered to capital asset or financial asset. And if the agreement is classified as a leasing agreement, there is no change of ownership, it is considered a operating lease. And the income of lease are recognized annually when the lease payment are collected. Okay, the next section is the advantage of the lease. The first, I will explain the advantage of the lease for the lessee. The first one is no down payment. It is very attractive for the companies that don't have sufficient cash to pay down payments, or for the companies that want to use the available capital for operating purpose as well as other investment. The second one, the second advantage is avoid of ownership. There are many risks in price ownership, such as loss due to disaster, wear and tear, and the economic condition. Lessee may terminate the lease even if it the subject to a fine, and thereby avoid taking the risk of such an event. And the last advantage for the lessee is the flexibility. If assets are leased, the firm can replace asset more easily in response to change the asset. And next, the advantage for the leaser. The first advantage is increase the sales. Offering product through leasing to potential customer can increase sales by a large number. The reason may be that the customer don't want to unable to buy asset in cash. And the second advantage is ongoing business relationship with lessee. If the price is sold, the buyer sometimes doesn't make any more transaction with the sellers. But in leasing, the lessor and lessee remain in contract for a certain period, and a long-term business relationship can always be established. And the last advantage for the lessor is residual value retained. In many lease agreement, the right to the lease property never pass to the lessee. The lessor benefits from the economic condition that create a large residual value at the end of the lease period. The lessor can lease back the asset to another lessee or sell it and make a profit on the spot. Next section is the definition of bank. There are many definitions of bank from the many sources, of course, but in this paper, I only choose 4 such definition of bank. The first source is from IAI, Ikatan Akuntan Indonesia, in PSAK number 31, state that bank is an institution that acts as a financial intermediary between parties that own funds and thus requiring funds as well as an institution that function as payment traffic. Second source is from UU number 10 1998 that amended from UU number 7 1992 state that the bank are business entities that collect funds from the public in the form of saving and channel other forms of credit in order to improve the standard of living of the people at large. The next source come from Abdurrahman in 1999 state that a bank is a type of financial institution that carries out various services such as providing loans, circulating currency, monitoring currency, acting as a storage area for valuable objects, financing companies' business, and so on. And the last source from Stewart in 2003, according to Stewart, a bank is an agency that aims to satisfy credit needs either by means of its own means of payment or with money obtained from other parties or by circulating new exchange instrument in the form of demand deposit. Next is the definition of bank from its function. First is bank as credit recipient. Bank carry out the credit operation passively by receiving money and other funds from the public in form saving, deposit, and so on. And the second is bank as lender. Bank performs lending operation actively without questioning the origin of the fund, either from time deposit, public saving, or from the bank owns capital. And the last is bank as creditor, whose funds originate from their own capital. Bank actively carry out credit operation whose funds are obtained from the bank's own capital. From the definition of bank, it can be concluded that the bank credit is the distribution or provision of fund by banking institution originating from public fund that have been successfully collected, where the bank will recover the credit extended by adding a fee or interest for a certain period of time. Next is the element lending the credit. The elements contained in lending credit are the first one is trust. Trust is the confidence of the lender or creditor that the credit given to borrower or debtor in the form of money, goods, or service will actually be received back in the future. And the second one is agreement. This is stated in an agreement regarding the right and obligation of each party. The agreement must be signed by each party. And the third one is period. It is the agreed credit repayment period. Each credit must have a period of time. And next is risk. Risk factor for loss can be caused by deliberate and accidental. Deliberate loss is the debtor's intention not to pay his credit. Loss due to accident occur due to calamities, such as natural disaster. The longer credit period, the greater the risk of uncollectible credit. And the last one is remuneration. Creditors certainly expect an advantage from the credit facilities they provide. The gain on guaranteeing a credit is known as interest. As previously explained, each credit contains a risk of the debtor's inability to pay off his credit. The debtor's inability to pay off his credit can be covered by a credit guarantee. The credit guarantee function is usually higher than the credit score. The most important thing in credit guarantees is to bind the debtor to pay off his credit immediately, considering the credit guarantee will be confiscated by the creditor if the debtor is unable to pay. Because of that, there are credit guarantee to ensure that there are the credit guarantees. The first one is good guarantee, such as land, building, vehicle, machine, and so on, and other goods. I mean, okay, the second one is securities guarantee, such as share certificate, bond certificate, land certificate, deposit certificate, and other securities. And the third one is person or company's guarantee. It is if the credit is bad, then the person or companies that provide the guarantees is the one who is asked to be responsible or bear the risk. And the last one is insurance guarantee. It is the guarantees to the insurer, especially against physical object of credit, such as physical, buildings, and other. So, if there is a loss or fire, then the insurance party will bear the loss. In addition to requiring a guarantee, the creditor charge the debtor credit interest rate. In determining the charging of interest rate, creditor consider the risk level of each credit. Credit interest rate can be determined in two ways. The two ways include the fixed rate and floating rate. At fixed interest rate, the amount of interest that the debtor must pay during the agreed period will not change. But in floating interest rate, the amount of interest to be paid by the debtor may change according to the interest rate determined in the period concerned. Next is the difference between leasing and bank credit. The first is from leasing, we don't need a guarantee, and from the bank credit, we need a guarantee, as I explained before. And the second one, from leasing, the capital goods owned by lessor, and from the bank credit, capital goods owned by the company. So, in leasing, lessee doesn't pay tax on ownership of the capital goods. And next, from leasing, lessee record as liabilities, and from the bank credit, record as depreciation. In accounting, the lease contract is not categorized as debt, which means that it does not appear on the liability side of the lessee balance sheet. In terms of debt or equity ratio, the lease contract doesn't reduce the lease ability to get a loan from the bank. Consequently, leasing is needed as an operational expenditure item that will reduce the amount of profit before tax, while through the bank credit, the deduction is the depreciation of capital goods. And next, leasing is secure, but bank credit is not secure. If a lessee is declared bankrupt, the lessor is safer than a bank, because in that situation, the lessor can take back the leased capital goods immediately. On the other hand, it is not easy for the bank to withdraw credit or execute collateral or guarantee, because it requires certain legal procedure that definitely take time. And the last one, leasing easier than bank credit. The requirement for leasing easier than bank credit are more difficult because of the obligation to provide a building, which is the asset of the debtor, and the lease interest rate tends to be higher than the bank interest rate. The last chapter in this paper is the conclusion. From the explanation, the conclusion is the leasing is more profitable than the credit bank on fulfillment the fixed asset. As my explanation of difference between leasing and bank credit. So, I give the recommendation for the company on fulfillment fixed asset to choose leasing than the bank credit because leasing more secure and easier than bank credit. So, I think that's all. Thank you for your kind and fine attention. I hope you understand with my explanation. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.